Hi there, welcome back to J Trading. I'm happy to see you back here. If you're new to the channel, please consider subscribing. Otherwise, you know what the drill is. Today we'll be analyzing the market. From today onward, we'll be uploading 6 videos per week. 3 videos will be analysis on Deriv Assets, and the other 3 will be forex currencies. So today we will see some market patterns, maybe charts on Boom 500, Boom 300, and Boom 1000. Without a further ado, let's dive right in. So the first chart right here is chart for Boom 500. Always go to a higher time frame. The first thing you need to do is go to the highest time frame that you want to start with. Most of the time I start with the weekly chart if I want to analyze for the long term, but today we will be starting from only daily time frame. So in a daily time frame we have this type of chart for Boom 500. Then after choosing your time frame, the next step to do is cleaning your chart. If you have previous objects like this, you need to remove them in order to see the chart clearly. It will help you to see the market without any obstacle. So this is the clean chart of Boom 500 on a daily time frame. Since today is Monday, we have a big week ahead of us. So for this week, what may happen on Boom 500? That is what we are going to do right now. So in order to do that, starting from the higher time frame, or maybe daily, or maybe weekly time frame would be the best thing to do. So now we have a chart which is very neat like this. So the next step will be always identifying a reversal point or rejection points, or those candlesticks with big wicks. So first let's identify reversal points. We have a reversal here, market reversed here, market reversed here. Actually this point here, it's the lowest point, so you can take it as the swing low. This low is called swing low, or the lowest point in the current time frame that you are watching. Then from the upper side we have another reversal. Here we have multiple rejections. This area can be a confluence zone, we will see that later. Then we have from the lower side here, from the upper side here, and we have another, the highest reversal point, and this is called swing high, the highest point where the market has reversed. This is called swing high. Then we have another reversal here, reversal here, reversal here, and here. So after identifying all these reversal points, the next thing you need to do is connect all those points which might be at the same level. If they are at the same level, those can act as a support or a resistance, or sometimes a trend line. So here we have, at this level I see a lot of rejections. Here we have a rejection, here we have rejection. All of them are almost at the same level, so I'm going to put a box over there. By the way, most of the time when I analyze the market, it's almost the same. All the steps I follow, there is nothing new. Just follow these simple steps. That's it. You need to spot these reversal points like this, or maybe wicks. So here we have a reversal, a rejection, multiple rejection. That means the market is reacting at that level, or traders are taking action at that level. That means next time when the market price approaches to that level, there is high chance or high probability that traders may act again, or either sell or buy. So you need to be active on those levels. So this will be one of those levels. Then from the lower side also we have the same rejection points at the same level. You see this box is holding this point here. The market bounced up from this box, again it came back down to this level, then it bounced back up, it came third time, bounced back up. That means this area is I think as a support. So the next time the market comes back to this area, there is high chance that it will bounce. But when it came back down here at the next level, it didn't bounce, unfortunately. It broke down with high momentum. So this is a place where you take a trade thinking that the market broke downward with high momentum, so you think, it broke this support, so there is high chance that the market will go down, right? So you take a sale here, boom, the market reverses back. So if you go near here, you can move this rectangle here to the right like this. So let's see, look, here we have wicks, right? We have another wick here, another rejection, a rejection, another rejection, and another rejection. So this box got tested many times, multiple times it rejected the market, but finally here the market was able to move out of the box, or it broke up. So if you're not sure that this is a legit breakout or a false breakout like this one, you can wait for the market to come back up and get rejected. How does it get rejected? Let's get a closer look. See, I don't say this much on YouTube, but let me show you. The market broke up at this level. You're not sure, so you have to wait for the market to come back down. When it comes back down, what you need is wick like this. See this wick, right? Wicks, by the way, the meaning of wicks is it's uncertainty. So here at this level, at the box, sellers were trying to push down the price, the market, but at that box level, there was uncertainty. Those sellers, they were in despair, so they took their position, they closed their position, and the buyers stepped in. That's how these wicks get created at this key support area. So at support area, if you see a wick, it's always a message for you, either for a sale or for a buy. So this wick is a message for you. You go for an entry on a lower time frame, then you take a trade. Let's go to lower time frame, maybe 1 hour. Then we will see how we can take an exact sniper entry there at the level we have talked about. Let's see this. So this is the area where the market broke out, then it came back down. At this level, the market keeps bouncing here. You see, on a lower time frame, even on 1 hour time frame, we have a wick over here. We have another rejection or a reversal here. Then the market was able to push up with a big momentum. So that's a signal for you to take a buy position here. Put your stop loss just below this box, maybe at this level, then wait for the market. Some students, they have been asking me, your stop loss is too huge, your take profits are too huge. How are we supposed to wait for days? My brother, let me tell you, if you're not patient to wait for days, or at least for the market to touch either your TP or your stop loss, you're not gonna make it. It's very tough. I mean, look, if it was easy, everyone will be making money in boom and crash. The psychology behind Deriv Assets is always to keep people in a loop. I keep telling you this a lot of times. If you're not wise enough, you're gonna lose your money to Deriv. I have a lot of friends who started trading on Deriv, but they kept losing their money each and every time. But they come back to Deriv. You know what that means? That means the psychology behind it is keeping you in a loop. You come back, you put your money, you deposit, you lose, then you go, you make another money in a 9 to 5 work, you come back, you put, because you have a hope that you're gonna make it in Deriv. You know why? Because on a lower time frame, especially on one minute, each and every minute the chart is going on one way, in one direction. That means you keep telling yourself that, okay, if I put sell in boom, that means every minute I'll be making money. Before the spike comes in, I'll take my profit. That's what you think, but behind that there is a lot of secret. It is a code, it's algorithm, so you need to be wise. Okay, so the boom 300 chart on daily time frame looks like this. The first step is spotting reversal points. Here we have a reversal, we have another reversal, a reversal here, another reversal from the bottom. Then the market is playing at this level, making a consolidation. So what is really happening here? How can we take a trade over here? So let me show you. Here we can connect these upper level reversals like this as a trend. That means the market was trending downward. Every time it touched this trend line, it bounces back down, and from the lower level also the market was bouncing up from this trend line. Here it bounced, here it bounced again, and at this level it tried to break but it didn't, so it tried to bounce back up from this level also. So this is a daily time frame. If you zoom in here, we have something which looks like a consolidation, but I see a pennant here. This pattern is called the bearish pennant. If you connect these levels from the upper side like this, all the reversal levels and the rejections or the wicks, and from the lower side also you can connect like this. So this pattern is called a pennant, bearish pennant. What actually happens here usually is market comes like this with a huge momentum. After a huge rally, always market takes a breather. So it's taking a breather here, it's resting here. So the market is going to decide which way it's going to go. So most of the time this pattern is a pennant, it's a bearish pennant, so it breaks downward and continues the rally after taking a rest. But who knows, since this is very a lot of weird things happens, so it might break up also, so you have to wait. What I say here is wait for the market to break out of either this lower trend or upper one, wait for a retest on the lower time frame, then you take a trade. So I don't want to say a lot today. This is it for Boom 500 and Boom 300. On the next video I'll come up with another analysis on either boom or crash. Then on the other videos also we'll be doing analysis on forex currencies. I think we will have a good time together. So if you have enjoyed the video, please put a thumbs up, and if you're new, please consider subscribing. I'll see you in the next video. Peace out.